On the EFA daily chart in front of you, you're looking at a basket of developed markets outside the United States, Japan, Europe, Australia, and more in one ticker. 인 A1이 매프트 더 S&P 500, 나스닥, 앤드 다우. Today we flip the camera. How do you read the rest of the world when your account is priced in dollars? Think of global equities like sections of the same newspaper. U.S. home tape, Japan, Europe, emerging markets, each lighting up a different slice of growth, rates, and risk appetite. Once this overseas map is clear, Fed headlines and a strong dollar, DXY, stop feeling like noise. You can see which regions they hit first. Let's learn how to read the global map together. Outside the NYSE and NUG, three hubs matter most for a dollar-based investor: Japan, Europe, and the emerging market complex. Japan's Nikkei 225 on screen is the classic Tokyo thermometer, price-weighted, heavy on exporters and industrials that feel yen moves and U.S. demand. Europe's broad gauge, Stoxx Europe 600, mixes banks, luxury, energy, and industrials across many countries, more old economy, weight than a heavy U.S. sleeve. Emerging markets, think China, India, Brazil, Taiwan, Korea as a group, often swing harder on commodity prices, local politics, and dollar funding stress. Remember the trio: Japan for Asia developed, Europe for multi-country developed, EM for higher beta growth and commodity cycles. On the Stoxx Europe 600 daily like the one on screen, you're still in developed markets, liquid, heavily researched names. Emerging markets sit a notch riskier on the same map. Developed overseas, Japan, Europe, Canada, Australia, usually move less violently than EM in a risk-off week, but they still can diverge hard from this and pay 500 when the Fed hikes or the dollar rips. Emerging markets can feel like a neighborhood coffee shop that jumps from $3 to $4.50 overnight, while a national gas brand's pump price barely budges. Same inflation story, different volatility. Historically, when global growth reaccelerates and dollar funding eases, EM often leads. When credit tightens, EM often sells off first. That pattern repeats. It is not a law. Always pair the equity chart with the dollar backdrop. A roaring local market can still disappoint in your brokerage if FX works against you. Look at the EFA daily again. Hundreds of foreign companies sit inside, but they are not equal. Market cap weighting means Japan, the UK, France, Switzerland, and Germany often dominate the punch. Same idea as the S&P 500's megacap concentration, just with countries instead of Apple and Microsoft. A handful of large markets can drive most of the gas day. That is why investors watch country weights the way U.S. investors watch the Magnificent Seven. Miss Japan or Europe's banks and your international sleeve can lag even when headlines sound fine. Picture a classroom of 500 students where the top 5 scores pull 30% of the class average. If those 5 stumble, the average falls with them. So if the S&P 500 is up and your international TAPA is flat, check whether Japan, Europe, or FX, not the world in the abstract, miss the move. Compare a developed overseas basket, EFA, with an emerging markets TAPA like EM on screen. EM usually carries more tech manufacturing, commodities, and policy risk, and often more day-to-day volatility. In risk-on stretches, think post-crisis rebounds or AI supply chain booms, EM can outrun developed international by a wide margin. The Nasdaq can outrun the Dow in a growth mania. In stress, 2008-style credit scares, or a sharp Fed hiking cycle, capital often flees EM first and parks in U.S. Treasuries and megacap U.S. cash flow names. History rhymes. It does not guarantee the next print. Europe and Japan still hold more banks, industrials, and defensives than a pure EM growth sleeve, which is why their drawdowns can look different from EM even on the same Fed headline. Chasing growth abroad? Watch EM and export-heavy Asia.
Want to broader developed diversification next to your S&P 500 core.
Keep EFA-style exposure on the dashboard. The Toyota ADR, TM, daily on screen is a Japanese company trading in dollars on a U.S. exchange. That wrapper is an American depository receipt. ADRs let you buy foreign names without opening an overseas brokerage account. Sony, Nestle, ASML, Taiwan Semiconductor. Many blue chips have a U.S.-listed path. You still own foreign economic risk. The local stock, the yen or euro, and overnight news in Tokyo or Amsterdam can move the ADR before the U.S. cash open. Liquidity and fees differ by ADR. Some are thick and cheap to trade. Thinner ones can gap harder, like a corner store's price tag versus a national chain sticker. For a dollar portfolio, ADRs plus international temperaments are the two practical doors into the map we just drew. Neither is magic. Both need the same risk rules as any other equity. Recap. EFA style developed overseas covers Japan and Europe. EM gauges the higher beta sleeve. ADRs are the single-name dollar on-ramp. Treat overseas indices as early signal lights. Tokyo and Europe print before New York. Often you see the mood in Nikkei and stocks before the S&P 500 cash open. In practice, before you size U.S. risk tomorrow, glance at Nikkei, Europe and EM tepa and the dollar. 4 quick reads beat guessing from headlines alone. Reading those signals makes your S&P 500 and NASDAQ positions clearer, not because foreign charts predict the future, but because capital is already global. Finally, this lesson is educational only. There is no guaranteed return and no magic formula. Charts are tools. Every decision and every loss is yours alone.